Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Monday. These are the stories that set your agenda. Asian stocks rally after Fed Chair Jay Powell signals an interest rate cut could come as soon as next month, despite division among policymakers over inflation and the jobs market. Intel investment. The US government takes a near 10% stake worth $8.9 billion. This as tech investors brace for Nvidia earnings on Wednesday. Plus, Ukraine and Russia exchange prisoners of war as truce talks appear to stall. Well, let's get to the markets then. Happy Monday, bank holiday, of course, here in the UK. But it's the pivot, of course, from Jay Powell that remains front and centre for these markets. Now pricing in around an 84% chance of a cut in September, despite, of course, the question marks that continue over the health of that labour market in the US and the trajectory, of course, of inflation, the uncertainty being underscored by the Fed chair, even as he opened the door for a September cut. The first, of course, of this year, if indeed that comes through. European futures then pointing low by 0.3% after a strong rally on Wall Street, with the small caps powering to gains of almost 4%, gains of around 1.5% on the S&P 500, the Nasdaq 100 closing up by close to 2%. Today, S&P futures pointing a little lower, down by 0.1%. Nasdaq 100 futures off by 16 points. Let's flip the board and have a look cross-asset. You had money, of course, moving into the front end of the yield curve on the back of that Powell speech. Yields falling around 10 basis points on the 2-year. Today, the 10-year is yielding at 4.26. Yields just up around 1 basis point. A little bit of selling pressure, pairing some of the gains, but certainly not all of them that came through on Friday. Today, in the session, yields up around 1 basis point across the curve. Euro dollar at 117. You're seeing a little bit of strength for the dollar in the session today. The single currency then down 0.1%. Brent crude trading at $67 a barrel, and gold currently down 0.2%. So Asian equities gaining the most in nearly 2 weeks, taking the baton then from that strength coming through from Wall Street as traders increase bets that the Fed will lower rates next month. We're joined now by Paul Dobson, Bloomberg's Asia Markets Executive Editor. Paul, walk us through the Asian market reaction then to what we've been hearing from Jay Powell.
Yeah, good morning, Tom. I think it's pretty much by the book, as you would expect. On Friday in the US, we saw stocks up, we saw we saw lower Treasury yields, and we saw a weaker dollar as people priced in the idea that the Fed would be moving sooner. And the weaker dollar is very supportive for global assets, and that followed through with Asian currencies gaining, and Asian stocks also pushing higher pretty much across the board. The idea being not only will Fed easing boost global demand, but it will also give Asian central banks a little bit of leeway, a little bit of breathing room, in order to cut their own interest rates a little bit further as well, which would be supportive for the economy and lead to more inflows. And if you look at the outlook for emerging markets globally relative to US markets, the prognosis is for bigger gains overall in emerging markets, because you have that sort of outperformance when the US economy is humming along nicely, and a little bit of uplift as well from the currency. So people looking at something like 15% gains, I think it is, for emerging markets over the next 1 year, relative to 10% for developed markets.
OK, 15% gains for emerging markets over the next year versus 10% for developed markets. In focus right now is the strength, of course, and the question marks about the resilience of the Chinese equity rally and the boomers there. And now question marks, Paul, as to whether or not we're seeing something of a bubble when it comes to Chinese equities, given the fundamentals of that economy.
So in the background, one of the things that the Fed is thinking about quite carefully are Trump's tariff regime. And of course, China is one of the places where that's going to hit the most. And so we saw a very positive first half of the year for China and for its economy, because people were front loading their exports to try to get ahead of the tariffs. And yet we're still seeing plentiful demand and exports still humming along relatively soundly at the moment. Yet, all of those economic signals that had been positive in the first half of the year are starting to turn a little bit more negative for China into the second half of the year. We had a bunch of misses in key data over the last week or two as well. And so people are wondering, if that's the case, if the economy is slowing, then why is it that equities are continuing to rise? Another update today, and pretty hefty volumes as well to add into that. And I think that there's a couple of things going on there. One, there's plenty of liquidity in the market. The Chinese government doesn't want to crash the bond market by accident. It wants to ensure that there's enough liquidity out there to take down bonds, but some of that is seeping and finding its way into the stock market as well. And two, there isn't a great deal else out there for people to invest. They were sitting flush with cash. Property still looks like a dismal bet if you're a Chinese investor. And you're looking for alternatives. You're not getting much from bank deposits. You're not getting much from fixed income. So people are happy to put a little bit more to work in the equities market in any case. And so what we're seeing is this slow and steady run higher, not the kind of tearaway gains that we're used to in China that would really make people worried about a bubble. And yet it's pushing those valuations to quite stretched looking levels that would need economic growth to follow through at some point in order to justify where we're starting to trade now.
OK, stretched valuations over in China as that equity rally continues. Paul Dobson, our Asia Markets Executive Editor, on some of the Asian market reaction as well to the Fed and what we heard from Jay Powell on Friday. Paul, thank you. Let's get more details on that story then. The Federal Reserve's Jackson Hole Symposium, of course, was a tense affair, with Chair Jerome Powell signalling an interest rate cut as soon as the next policy meeting in September, despite clear divisions among policymakers. The chairman noted the economy has handed Fed officials a, quote, challenging situation.
The baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Our policy rate is restrictive, modestly so in my view. The stability of the unemployment rate and other labor market measures allows us to proceed carefully. While the labor market appears to be in balance, it is a curious kind of balance. Longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored. We will not allow a one-time increase in the price level to become an ongoing inflation problem.
Well, discuss that challenging situation. I'm joined now by Mark Cranfield from Bloomberg's Markets Live team. Mark, Jay Powell then certainly seemingly validating the market bets on September. Then the question is, what next? And the challenges and the lack of clarity seemingly for this Fed on key questions around inflation and the labour market. Is this a Jay Powell who was at least laying the foundations maybe for a more challenging road ahead for this Fed?
He may well be. As far as investors are concerned, they're very much more focused on the very short term. So the message that people heard from Friday was that it's going to be very difficult now to dial back expectations of a rate cut not coming in September. So it's pretty much signed and sealed as far as investors are concerned, particularly those in the equity and the bond space. Jerome Powell's still got a couple of weeks. He can persuade. There's not unity within the Fed. There are different voices. People have different views on when the timing is right. He's still got a couple of weeks where he can go ahead and smooth that and get to a consensus decision by September. Beyond that, it's a different story. But for now, the financial markets are not really too concerned what happens after that time. They're really much more interested in the fact that finally the Federal Reserve have put themselves in a position where they're on the same page as where traders have been for some time. Traders have been looking for a rate cut for several weeks. It looks as though everybody's aligned now. That gives a nice backdrop to financial markets, at least in the short term. And that's what you're seeing playing out, exactly as Paul Dobson was describing there earlier. No doubt there'll be a few data points along the way. There'll be some speed bumps. But it would really need to have something shocking coming out of the inflation data that we're going to see before the next Fed meeting for them to change their mind. It's really what happens beyond September is really a discussion for later down the road. For now, investors are just relieved that they can look forward probably to a couple of weeks of some pretty steady trading. We've still got Nvidia earnings to get through. That's a potential speed bump. But if you think of how many times they've beaten expectations, people are probably fairly relaxed about that as well.
Yeah, Nvidia may be the risk event of the week now as we look ahead to Wednesday. Of course, we heard, Mark, from a number of Fed officials and other central bank heads as well at Jackson Hole, as we do on an annual basis. And we also heard from Japan's, the BOJ's Ueda, and a cautious tone coming through from the central bank head over in Japan.
Well, there you have the outlier. Most of the world is trying to move towards slightly lower interest rates. Their inflation rates have been coming down. The Bank of Japan is in a completely different position. Inflation is very sticky in Japan. It hit 3% again in the latest readings for the Japanese CPI. And Governor Ueda has been looking for a window to move the next 25 basis points onto the table. Japanese interest rates, the official one, is only 0.5%. He probably would like to move it closer to neutral, which is around 1%. It looks as though he's been given that window. Scott Bessent, the Treasury Secretary, has criticised the Bank of Japan for being behind the curve. He's just spoken at Jackson Hole and reminded everybody that wage inflation in Japan is still high. It's a tight labour market. It's likely to get even hotter in the months ahead. That appears to be his way of telling the market, yes, we're getting closer to a rate hike. I've been given cover by my foreign counterparts, and it looks as though they're trying to push the market pricing for the October meeting really to fully confirm it before we get there. That's what central banks tend to prefer. They like the market to fully price in a cut or a hike in this case. You've still got some time. At the moment, it's a coin toss, but you can see JGB yields are edging higher, and the market is getting in tune with the fact the Bank of Japan have got one more hike to do, and it's probably coming, not the next meeting, but probably the one after that.
OK, the BOJ laying the groundwork potentially for another hike, or at least the last one potentially of this year. Mark Cranfield from Bloomberg Markets Live team, of course, on what we've been hearing from Jay Powell and other central bank governors at Jackson Hole, how that ties in, of course, to monetary policy globally. Meanwhile, US President Donald Trump on the tech front sealing a deal that has given the US government a nearly 10% stake in Intel. The move comes as the US administration seeks to reinvigorate the company and boost domestic chip manufacturing. To discuss and get the details, let's bring in Bloomberg's Annabelle Drulers, who, of course, covers technology for us out of Asia. Annabelle, what do we know? The team have been reporting around this deal. Now it's confirmed. What are the specifics of this deal?
Yeah, I think actually the specifics sort of match up to a lot of what we had already been reporting, but just to sort of go through some of the big contours or broad contours. Firstly, in terms of the size here, you said, yeah, just under 10%. So the US government is buying up to 433 million shares of common stock. The deal itself, in terms of the monetary value, it's worth around $11.1 billion. That is the funding that the company was slated to receive. Some of it had already received, but under the US Chips and Science Act. So that's sort of what we'd already been reporting, what we knew. What's different now, the additional details, is that we understand the government is going to be a passive owner, which means they're going to have no board seat, they're going to have no other governance or information rights. In terms of the reaction of the companies to this, well, Intel is saying it's very grateful for the support. President Trump has been on social media, but also talking about how this is a great step for Intel. It's also a great step for America. And what's also important to note is just the animality of this, because it's very unusual for even partial government ownership of a US firm by the US government. But it does really underscore the significance of the overall project, because we know, of course, the Trump administration is very focused on building up the US's capabilities in semiconductor manufacturing.
Yeah, indeed. And a reminder that this is a more interventionist Trump administration with stakes in steel and rare earths, and, of course, that 15% stake or take, at least from sales of Nvidia and AMD into the Chinese market. Talking of Nvidia, Annabelle, I know you're going to be watching this one very, very closely as well this week. The earnings dropped late Wednesday. How much expectation is built in to the Nvidia story at this point?
I think there's a lot. I mean, I'm going to be watching it, but I'm sure there's going to be many people that are going to be watching this very, very closely from a lot of different angles as well. Nvidia as a company, I mean, it makes up 3% of global market cap. It is the heaviest weighting on the S&P 500. You can see there around 8.8%, rather 7.9, but just under 8%. But the point is, I mean, it's very, very significant for exactly how global markets perform from here, because we've already seen tech stocks that have been under pressure. And the concern has been, once again, that there's maybe overspending on AI, or that the technology, the rally, maybe doesn't have legs. So we really need to understand from Nvidia What's the outlook here? And that's what we're going to get, of course, from the numbers, really that big focus on the earnings calls and what's really signaled from the company. In terms of the actual numbers, I mean, some of the expectations is around a 50% increase in revenue on the year, adjusted earnings per share of $1.01, and options prices as well. Options traders pricing in some pretty big fluctuations, 6% in either direction is the prediction right now. As the other big question, of course, is what does Nvidia say about the Chinese market? You mentioned there, of course, these restrictions we've seen on H20. They were reversed, or the Trump administration reversed the ban, but last week the reporting was that China had asked companies to halt purchase of H20. Now Nvidia possibly has halted production of H20 as well. So exactly what they say about the mainland market will be of interest to many, I'd say.
Okay. Annabelle Drulis, thank you very much indeed, joining us out of Hong Kong with a really great setup of what to expect from those Nvidia earnings, dropping, of course, late Wednesday. Annabelle, thank you. Here's what else to think about then through this week. Nvidia, of course, is part of that story. But before we get there, later today, Germany's IFO business climate data comes through. We've seen a bit of a turnaround in terms of some of the data when it comes to Germany, in terms of manufacturing PMIs. So we'll see if the sentiment survey confirms that when it comes to the business community of Germany. We'll break that down for you, of course, later today. On Wednesday, it is the Nvidia earnings story that Annabelle has just set up for you. And on Friday, it's European CPI. Maybe the concerns in Europe are around deflation. Maybe that's the story in terms of the trajectory of prices, particularly when you look at the strength of the euro and what that could do for a deflationary impulse. We'll see, of course, with the data crossing towards the end of this week on Friday. Talking of inflation, you do not, of course, have at-target inflation in the US. Despite that, Jay Powell is signalling that September cut. But the US PCE data on Friday will build on the inflation story, as there is a sense that some of those tariffs are starting to feed in at least to parts of the inflation basket in the US. We'll get more detail on that on Friday. Coming up, tensions with North Korea are likely to be a feature of talks between Donald Trump and his South Korean counterpart today. We're going to have more on that just ahead. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, South Korea's President Lee Jae-myung is set to meet with Donald Trump in Washington later today. Ahead of his trip, Lee met with Japan's Prime Minister as the leaders seek stronger cooperation with the US. Let's get more from Bloomberg's East Asia government editor, John Herskovitz. And John, South Korean presidents traditionally have gone to the US as their first foreign visit. That isn't the case with Lee. He's going to Tokyo, has been to Tokyo first. And of course, traditionally and historically, South Korea in recent history and Japan have been at loggerheads, and there's that historical tension. And nonetheless, there was this visit. Talk to us about how the dynamics between Tokyo and Seoul are tying in to what to expect from this visit.
Sure. I mean, the trip was unprecedented for a new South Korean president to make his first overseas trip to Japan. This really hasn't happened since the advent of full democracy there. But for Japan and South Korea, they're kind of in a similar predicament when it comes to the United States. They both have struck deals with the U.S. for trade with the 15% tariffs. They both agreed to some sort of fund. In South Korea, I think it's $350 billion. Japan, $550 billion, which is kind of nebulous. The U.S. sees it as one thing. Japan and South Korea see it more as loan guarantees, not actual money that's going to go in. And Japanese Prime Minister Ishiba has met Trump. So the meeting with Lee Jae-myung and Ishiba was a way to strengthen the ties between the two, to help Lee Jae-myung get some idea of what he's stepping into when he goes to the White House. Rather unpredictable situation. And things have changed a lot over the past year. 1 year ago, there were 3 different leaders for each of these countries. The cooperation among Japan, the US, and South Korea was at all-time highs. The 3 were cooperating in security matters. Their militaries were doing drills to hunt for submarines. They were sharing real-time data on North Korean missile launches. And now that the leadership has changed, the question of this cooperation is in question, whether this will continue. So Tokyo first, on to the U.S., and Lee Jae-myung is soon to meet with President Donald Trump.
OK, Bloomberg's East Asia government editor John Herskovich on that meeting expected, of course, between the South Korean leader and his US counterpart later today at the White House. Coming up, calling for cuts, former St. Louis Fed president and a contender to be the next Fed chair, James Bullard, backs 100 basis points of cuts this year. More from our interview next. This is Bloomberg. Welcome back. Former St. Louis Fed President James Bullard says he thinks there is a case for 100 basis points of rate cuts before next year. Bullard is a contender to succeed Jay Powell as Fed chair and spoke to us after Powell's comments at Jackson Hole.
He used the speech to solidify expectations for 25 basis points in September. I was expecting that anyway. Markets were expecting that. He leaned into the most recent labor market report, which was very soft. And so I think that's a done deal. He didn't say too much about beyond that, what you want to do with the October meeting or the December meeting. I have said 100 basis points, going into 2026. So I think you could adjust as you go forward and eventually get a full 100 basis points, but I would go slowly in order to watch the data. And then on the framework review, I'm sure much earlier in the year, they had targeted that they would have the framework discussion and that they would use the Jackson Hole speech to talk about changes to the framework. I thought those were thoughtful and they were well presented in this speech, and they're about what many have speculated on. So I think they did about as much as they can on the framework side.
Jim Bullard, Tom Keenan, good morning to you. I definitely consider this my conversation of the day. You served a lengthy term at the St. Louis Fed. You have lived the decline of a greater economy decades and decades ago in the effort to provide for a resurgent St. Louis. As the next chairman of the Fed, whoever that may be, do they have to manage for two American economies, a technology-driven, exceptional economy, and another, to use a cliche, America flat on their back? How would a chairman execute those two Americas?
Yeah, I think income and wealth distribution have become more salient topics for the Fed. It's not that clear how much the Fed can really do, providing interest rate policy for the whole economy. If you change the rate structure, that affects everyone, not just one particular group that you might be targeting. So I think that's been something we've had to wrestle with, and I've actually done research on it myself to try to understand it better from my point of view. So I think this has been a theme for a while, and that'll be an important theme in macroeconomics going forward.
Former St. Louis Fed President James Bullard speaking to Bloomberg's Tom Keene. In other news, France has issued an unusual rebuke to US Ambassador Charles Kushner after he accused French authorities of being lax on anti-Semitism. Kushner, who is the father of President Trump's son-in-law, Jared Kushner, made the accusations in a letter to President Emmanuel Macron. The French Foreign Ministry called Charles Kushner's comments unacceptable and say they violate a convention forbidding foreign diplomats from interfering in the host country's affairs. Coming up 3.5 years on from Russia's invasion of Ukraine, are we any closer to a peace deal? We discuss the impacts of the war with Peter Dickinson, editor of the Atlantic Council's UkraineAlert. That analysis is coming up. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks rally after Fed Chair Jay Powell signals an interest rate cut could come as soon as next month. despite division among policymakers over inflation and the jobs market. Intel investment. The US government takes a near 10% stake worth $8.9 billion. This as tech investors brace for Nvidia earnings on Wednesday. Plus, Ukraine and Russia exchange prisoners of war as truce talks appear to stall. Let's get to the markets then after that rally, of course, across US equities by the end of the close on Friday on the back of Jay Powell's pivot towards a more dovish stance and validating market bets on a September cut. European stocks futures a little lower, down 0.3% after notching fresh record highs by the end of the week last week. S&P futures down just 0.1%, a little bit of profit taking maybe after the rally that we saw on Friday. Nasdaq 100 futures pointing low by 16 points. That index, of course, will be impacted likely by the earnings from Nvidia on Wednesday. Let's flip the board and have a look cross asset. You had that strong rally at the front end of the curve on Friday. Today, pairing some of that with yields up around 1 basis point across the curve. The 2-year is currently seeing yields up 1 basis point. The 10-year also in similar territory at 4.26, closing in on 4.27 for the benchmark 10-year. Euro dollar at 1.17. Brent oil prices just marginally softer, and gold down 0.2% at around $3,363 per troy ounce. So Jerome Powell sending the US bond market up on Friday, yields down, by telegraphing the Federal Reserve could resume reducing interest rates as soon as September.
The stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
Let's bring in Ven Ram, cross-asset strategist for our Markets Live team. Ven, your reaction then to the response from Jay Powell, the adjustments in terms of risks when we have inflation well above target for the Federal Reserve and unemployment at 4.2%?
Morning, Tom. I think that, the unequivocal read from Powell's address was that he was dovish. I mean, the last year at the Jackson Hole, he set up the markets to expect rate cuts, and we got 2 big rate cuts last year. And I think he's setting up the markets for the same kind of setup here. And I think that, we should expect 2 rate cuts in the remainder of the year, one in September, probably the next one in December after that. Now, I do realize that inflation is still above target, but I think the question here is how restrictive the Fed policy is vis-a-vis inflation, vis-a-vis the unemployment rate. And I think that there is a bit of wiggle room here for the Fed to kind of go take policy rates lower. If you take realized inflation for this year, core PCE for this year, it's about 2.75, and that means that the Fed has room. If you pass the Taylor rule rate, it suggests that the Fed has room to go to 3.75 in the short term. And I think that's what they are setting, that's what Powell was suggesting, and that's what I think the market should prepare for.
How much, Venram, how much then do you think is currently priced in to the US bond market? So are we pricing in, traders are clearly betting on 2, to your point, by the end of this year. How much more adjustment do you expect to see across the curve?
I think, as you say, Tom, I think the markets are right in pricing in 2 for this year, but it's the question of how much that they're pricing in for 2026 that is at stake here. And I think that the markets are kind of mispricing how far the Fed could go. We've heard from Fed candidates, likely Fed candidates, including James Bullard, who is he's been, when he was in the Fed, he was one of the prescient Fed voices I used to always listen to. And he's saying that even 100 basis points by the end of this year is possible. I think that 2025 will see 2 rate cuts, but I think in 2026 that the markets are pricing in 80 basis points, and I think that the markets are underpricing the risk as to how far the Fed could go. Keep in mind that we are going to get a new Fed chair who is likely to be very dovish.
Yeah, a reworked Federal Reserve, of course, possibly more in Trump's image and what that could mean for policy in 2026. Ven Ram, thank you very much indeed. Cross-asset strategist for Bloomberg Markets Live. Staying on central banks, but with the focus switching to the ECB, where the Governor, Nagel, has stated that the European Central Bank would need a significant shift in economic outlook to lower borrowing costs again. The governor and president of the Bundesbank spoke to us on Eurozone policies at Jackson Hole. Here's what he had to say.
Germany has the capability to adapt to different situations. I think the world is changing. We are not happy with the current situation, so the trade conflict and everything is definitely not helpful. But at the end, we showed in the past our, let me say, strengths to come back and have a strong economy.
Post-Trump, can you and France and the other leaders of Europe reaffirm that growth, that spirit of growth that you had?
I guess we do something in the moment. We are going in the direction that you alluded to. We have structural reforms. We will do a lot of spending in new investments over the next year. So I think we do a lot of things in the moment, and I can guarantee you that there is a strong coalition on the European side. Germany, France, this axis is working again, and so I'm really confident that we can achieve a lot.
Given the fact that you could see some sort of mild recession in Germany, are you open to cutting interest rates further? After getting to 2%, which is sort of balanced, is it appropriate to become a little bit more accommodative?
Maybe a mild recession for this year, yes, this is true, but maybe we have also to think about that next year economic growth, there's a high probability that economic growth is coming back. When it comes to interest rate policy, I believe that we are in a kind of equilibrium. We have a 2%. We are on our target. This is good news. Interest rates are at 2%. So this is an equilibrium. So I do not see so many arguments that brings me to the point that we should do that we should do more here. So it's something. So I believe that inflation is not the point anymore.
Inflation is not the point anymore, that now it's potentially growth.
We are on our target.
But this is the issue. If inflation is not the issue, at what point do you see risk of disinflation, given the fact that the euro has been strengthening, right? That's importing disinflation. You have the potential for Chinese goods to be coming into the European region, cheap Chinese cars, that's sort of the cliche, that could lower prices. At what point are you going to be fighting disinflation again?
Well, it's definitely not time for complacency. So taking, for example, service inflation is still very high. It's above 3%. So we have to have this wait-and-see attitude. So this meeting-to-meeting approach is, I guess, the best way to do monetary policy in the euro system. When it comes to our September meeting, we will get new data, new projections, and then we will see. But at the moment, if I take all the numbers that I know, PMI numbers, I think not giving me enough arguments to change change the bars.
How high is the bar to cut
I think the bar is high. And so it needs a lot to convince me to change monetary policy.
ECB Governor and Bundesbank President Joachim Nagel speaking to Bloomberg's Tom Keene and Lisa Abramovich. Now, to geopolitics. Russia and Ukraine have exchanged prisoners of war. That's according to Russia's defense ministry on Telegram. The swap of 146 prisoners from each side was mediated by the UAE, the United Arab Emirates. It's the latest in a series of prisoner swaps this year and comes after the US Vice President J.D. Vance suggested Russia was willing to offer concessions to end the war in Ukraine.
I think the Russians have made significant concessions to President Trump for the first time in 3.5 years of this conflict. They've actually been willing to be flexible on some of their core demands. They've talked about what would be necessary to end the war. Of course, they haven't been completely there yet, or the war would be over, but we're engaging in this diplomatic process in good faith. We are trying to negotiate as much as we can with both the Russians and the Ukrainians to find a middle ground to stop the killing.
Well, joining me now is Peter Dickinson, editor of the UkraineAlert blog at the Atlantic Council, someone who, of course, has monitored this conflict from day one. Peter, is the Vice President of the United States correct in your assessment? Do you expect Moscow, do you expect Russia to make significant concessions when it comes to the question of solving and ending the conflict in Ukraine?
Good morning, Tom. Well, I'm not privy to what's been said behind closed doors, but what we see in public would certainly not suggest that the Russians are prepared to make any concessions. If we look at just specifically what was said and what came out of the recent summit meeting in Alaska, President Trump came out of that saying that he got concessions from the Russians in terms of an agreement to hold a bilateral meeting between Presidents Putin and Zelensky, and also the Russian acceptance of the need for security guarantees, which he framed as NATO-style, or certainly American officials framed as NATO-style security guarantees. Within days, we had from Moscow basically denials of this, saying that they were nowhere near ready to meet with Zelensky, and frankly speaking, was setting terms that suggested they would never want to meet with Zelensky, and also insisting that no Western troops be involved at all in security guarantees for Ukraine, and on the contrary, that Russia be one of the guarantors of Ukraine's security with a veto over any international guarantees for Ukraine's future security, which is obviously fairly absurd. So, this does not bode well. It doesn't suggest that they're ready to make concessions. It's not clear exactly what Vice President J.D. Vance has in mind, but certainly from the perspective of Kiev, it does not look like the Russians are preparing to make concessions.
You outline very, very clearly, Peter, that divergent dynamic in terms of the interpretation and the messaging that we're getting from both Moscow and Washington. How do you see that playing out then? Is this a Trump administration that at some point will lose its patience?
Well, that's the expectation. I mean, the assumption is that at some point that will have to happen, that the pressure will grow on Trump, specifically from his own base, his own, the domestic audiences in America, his own colleagues within the Republican Party, the foreign policy establishment, and also from European allies. There is a sense, I think, in Europe that Trump has to go through this process, and he has to understand for himself that essentially Putin is just stringing him along and does not have any intention of stopping the war at this stage until more pressure is applied to Putin and to the Russians. At this point, we're seeing a pattern emerging that's been actually going on fairly clearly for the last 6 months of the Russians engaging in displays of diplomacy, of calling for different formats of negotiation. We had the Americans and the Russians meeting in Saudi Arabia, first of all. Then we had Putin proposing for direct talks with Ukraine and Russia in Istanbul. Yeah. And now, of course, most recently, we have the Trump-Putin summit. Nothing has come out of any of them.
What would constitute, because the president of Ukraine was talking about this again over the weekend, what would constitute credible security guarantees for Ukraine?
Well, that is probably the actual crux of the whole matter. It's a very good question. And, some people here in Kiev say, actually, we shouldn't even be talking about security guarantees. We should be talking about partnerships, because the word guarantee is perhaps misleading. A guarantee suggests that the West is ready to fight for Ukraine, to defend Ukraine against Russia. And frankly, nobody here believes that, and I think they're right not to. I think it's unlikely. Everything we've seen suggests otherwise. So I think we're really talking about a long-term security scenario in which the West provides, maybe the Western emphasis would be on some sort of an air element, an air patrol, an air shield over Ukraine, and at the same time focusing very much on strengthening Ukraine's own military capabilities to make sure that the Ukrainian army has a very locked-in long-term support, that it has the technological capabilities, the industrial capabilities, the financial capabilities to present a serious deterrent to the Russians. That includes defending Ukraine itself, and also the ability to strike back powerfully against Russia inside Russia with long range strike potential. So missiles, in other words, cruise missiles, ballistic missiles.
Peter, you're living and breathing this. You're in Ukraine, you're in Kyiv, joining us this morning. What is the current state of the Ukrainian economy? How much resilience or lack thereof is there in that economy right now?
Well, resilience is the word, and then the resilience that we've seen over the last 3.5 years has been absolutely remarkable. I mean, it is literally incredible. It's become something of a cliche to talk about Ukrainian resilience, but nevertheless, it is the case. I mean, the economy took a massive hit. It essentially collapsed in the first year. GDP dropped by around 28%, but it's grown over the past 2 years, and it's on track to grow again this year. Not huge growth, but it's growing. I think it's about 5% in 2023, then around 3.5% last year. It's on track for around 3% growth this year. So there is a remarkable amount of activity. Businesses have proven very, very adaptable. They've managed to rework around huge logistical headaches, for example. But there are massive underlying problems. So we're talking about a country that suffered the displacement or loss of around 25% of its population. 20% of the country is under occupation. So there are huge challenges, and the country, the economy, however resilient it is still very much at the moment dependent on external financing to make sure it keeps ticking over. If that were to become vulnerable if there were to be a significant decrease in the financial support that Ukraine's getting from its Western partners. That would also have a major negative impact and perhaps also spark a new crash. But for now, it's remarkably strong, and they are sort of pushing along and struggling along.
OK, Peter Dickinson, Smart Insights, UkraineAlert editor at the Atlantic Council, joining us from Kyiv. Peter, we appreciate it. Coming up, wind farms to weapons of mass destruction. This week's Big Take looks at the rise of ESG equity funds into the nuclear arms industry. That story is next. This is Bloomberg. Welcome back. ESG-labelled funds are increasingly investing in the deadliest weapons ever manufactured. Since Russia's full-scale invasion of Ukraine, funds exposed to nuclear weapons companies have soared more than 50%. For the analysis and for the reasons, the rationale, and what is underpinning in this, let's bring in Tasneem Broga, Bloomberg's EMEA ESG managing editor, who's been doing a deep dive with the team on this. Tasneem, what is then driving this pretty kind of counterintuitive, or at least counter-consensus shift that we're starting to see into ESG or ESG funds into some parts of this nuclear weapons industry?
Yeah, good morning, Tom. Well, you mentioned one of them yourself, which is obviously the full-scale invasion by Russia into Ukraine in February 2022. That was obviously a major jolt. We've had a cooling in relations between the US and Europe, and then obviously NATO has now set or agreed on a 5% of GDP defence spending target. Now, all of this together has left Europe in sort of an historic moment of rearmament. At the same time, for several years now, Europe has been one of the world's most ambitious region when it comes to ESG investing regulations and its framework around that. But obviously, to have one framework fundamentally in opposition to the other, namely ESG and rearmament, is just not practical. So we've had we've had European leaders rather, and some of Europe's biggest asset managers come out and say that now's the time to drop exclusion policies on weapons manufacturers. And many of these weapons manufacturers also produce for the nuclear arms industry, and that's why we're seeing this development now.
And how significant, in terms of the numbers, are we talking when it comes to the fund flows into some parts of these equity markets, the ESG label into some of the defence space? Yeah.
Well, I mean, just to take a step back and sort of explain the context of this analysis. So we worked with Bloomberg Data and we worked with Bloomberg Intelligence, and what we did was we looked at a fund universe called Article 8, which in Europe is supposed to be funds that promote ESG, and then another universe called Article 9, which is funds that have ESG as their outright objective. The Article 9 universe was much, much smaller. The Article 8 universe was huge. Together, these two in total represent almost $9 trillion worth of assets. And then in terms of the companies that we looked at, we had an exclusion list that was compiled by the Norwegian Sovereign Wealth Fund based on companies that it deems unacceptable to hold because of their exposure to the nuclear arms industry. We looked at exclusion lists proposed by PAX and by ESG Book, and that was then calibrated with the help of BI and Bloomberg Data. And in all, we found that the exposure is about $20 billion. Now, that's just a small fraction of the total weapons industry that we looked at. However, the point is that, as I said, Europe has by far the world's biggest ESG investment industry. And this is the beginning of a new era in terms of rearmament and a new sort of mood in terms of what's acceptable for these ESG funds to be exposed to. So it seems like a significant development that we've seen already within these few years, this huge shift, and certainly a development to watch.
OK, a significant development, and one that is, of course, unpredictably sparking something of a debate within ESG investing circles. You can get more of that, of course, on Bloomberg.com and on the Bloomberg terminal. Tasneem Broga, Bloomberg's managing editor for EMEA ESG. Thank you. Now, the Trump administration has ordered work to be stopped on an offshore wind farm being constructed off the coast of Rhode Island. Denmark's Ørsted started the project last year, and it is 80% complete with all offshore foundations and 45 out of 65 wind turbines installed. That could be a stock to watch at the open, 8 a.m. UK time on the back of that news. There's plenty more coming up. We're going to check in on the Chinese markets and the inflation picture out of the US as Jay Powell opens the door to September. Stay with us. This is Bloomberg.
It's about balancing that commitment to restoring price stability with an understanding that preserving healthy labor markets also really matters for the public. And so doing that balance, I would say it's not a done deal in terms of what we do at the next meeting, but a range of possibilities is on the table, and we're going to get more data between now and then.
Boston Fed President Susan Collins speaking at Jackson Hole. We want to show you what's happening in terms of the inflation story out of the US because it's been ticking up. So despite the fact that you have Jay Powell, of course, opening the door to that September cut, if you look at the blue line, that is core producer prices. We know that came in as a surprise high at 3.7. We get the number later on Friday, of course, in terms of PCE, the Fed's preferred gauge. That is coming through with the yellow line, with estimates pointing to 2.8 in terms of year-on-year for the month of July, ticking up from the previous month. That is where the estimates are heading. So inflation is grinding higher in the US, and that is part of the conundrum, of course, for Fed officials. Let's flip the board and have a look at terms of what to expect from the September trading session. We're near record highs, of course. We got that boost again on Friday to US stocks after 5 straight days, a loss of the S&P 500. But September is traditionally a month seasonally where you are challenged. You can see the downside coming through here across recent years. A little bit of gain coming through in 2024, but prior to that, look at the losses that came through in September. So maybe brace yourself with that historical context as well. Let's flip the board again and have a look at what is happening in terms of the bubble over in China, at least as some have characterized it. Chinese stocks have been on a tear since April. You've added about $1 trillion, $1 trillion of market cap value across the Shanghai Comp and the CSI 300. This is the Shanghai Comp year to date. The gains are there, 15%. The rally's been really strong since April. There's been caution, though, from those saying, look, this is not built on fundamentals. The real estate sector is still challenged. The consumer is still a little soft. And yet investors continue to rotate out of bonds and into Chinese equities. How far can this rally go? Are we now in bubble territory over in China? The opening trade is coming up next. Stay with us. This is Bloomberg.